Today in this video I am analyzing companies which are into software related services, for example like application development, maintenance and outsourcing, enterprise solutions and digital solutions. These companies are small and mid-cap companies. The data available for L&T Infotech, L&T Technology and Mindtree is up to date till March 2019. Even Hexaware Technology's results are up to date till December 2018. Hexaware follows the calendar year of reporting. Let us begin this analysis by going to the graph table. The current market price of L&T Infotech is 1,498. L&T Technology is quoting at 1,449. Mindtree is at 690 rupees per share and Hexaware Technology's per share cost was 358 rupees. Next, let us look at what is the fall in these scripts from where it was quoting around a year back, that is from 52 weeks back. L&T Infotech and L&T Technology both have fallen around 25 and 22% each. Hexaware has fallen 29% and Mindtree has fallen 42% from its 52 weeks high. Here we want the fall to be as less as possible. Whenever the fall is more, it does create an opportunity, provided the ratios that we are analyzing are up to our benchmark. Next, let us look at the earnings per share and earnings yield of the latest 12 months data. Earnings per share for these companies like L&T Infotech and L&T Technology was 87 rupees per share and 72 rupees per share. Mindtree was giving an earnings per share of 41 rupees and Hexaware's earnings per share was 19 rupees. We have to compare these earnings per share with the price of the share, with that, which then gives us the earnings yield. Earnings per share as a standalone value wouldn't make sense until we compare it with the price, which would then allow us to understand what is the profit that the company has earned on each share price. All of these companies are quoting very nearby to each other, somewhere around 5 and 6%. Here we want the earnings yield to be as high as possible. One thing to note is that these profit values are excluding the extraordinary items. So if there is any extraordinary gain in the profit figure, then that gain has been removed, and if there is an extraordinary loss, then that has been added back to give the profit value. So you will see that the earnings per share may not match with different websites which provide the data for analysis like moneycontrol.com. So as I mentioned, the higher the earnings yield, the better it is. Next, let us look at the price to earnings ratio of the recent 12 trailing months. L&T Infotech's price earning was 17.2 times, which suggests that the price was quoting 17.2 times more than the company's earnings per share. Here we want it to be less than 25 times. L&T Technology was quoting at 20 times its earnings. Mindtree was quoting 16.5 and Hexaware was quoting at 18.5 times. So here we want it to be as low as possible, so that we are not paying a very high multiple against the earnings of the company. Next, let us look at the historical price earning of the last 5 years and how or where the price was in the last 3 years compared to the earnings. This helps us understand whether the current price earning we are paying, is it above the average or very nearby to average or below the average. So if it's below the average, then we are getting it at a discount to its 5 years and 3 years average price earning. L&T Infotech and all the other companies are below 25 times, which is my benchmark. The highest price earning was seen for L&T Technology. Investors since last 5 years on average were willing to pay 23 times more than the earnings of the company. Mindtree was quoting the second highest at 19.4 times. In the current 3 years, average price earning highest was again for L&T Technology at 23 times. And Mindtree was quoting at 20.6 times its earnings of the last 3 years. This data is available from screener.in. So if anyone is interested, they can check out the website. Here too, we don't want the price earning to exceed 25 times when we start investing in the company. Price earning is just one part of the valuation metrics. We have to look at other metrics as well to understand the price and where the price is compared to different variables. So let us compare the price with the operating cash flow and current market price with the free cash flow. When we compare the price with the operating cash flow instead of price earning, what it means is we are looking at the cash earnings of the company instead of looking at the earnings. Now the difference between the earning, that is the profit value from the P&L account, and the operating cash flow value from the cash flow statement are two separate things. OCF is the profit that the company has earned from the operating activity of the business, and only the cash component is counted in this calculation. All cash inflows and outflows only are considered while calculating the OCF, that is the operating cash flow, and the free cash flow is calculated by removing out expenses incurred in buying of fixed assets from whatever the company had earned in the operating cash flow. So then whatever remains after spending on buying of fixed assets is the free cash flow. So we are also trying to understand where the price is compared to the free cash flow and where the price is compared to the cash earned through operations of the business. Here too, like price earning, we don't want to pay more than 25 times for the company's cash earnings as well as free cash flow. L&T Infotech's price to OCF was 18.6 times. The highest was seen for L&T Technology. Just like in price earning, price OCF wise also, L&T is quoting the highest. Hexaware is quoting at 19.4 times. And Mindtree is quoting at 18 times, the lowest in the peer group. In terms of free cash flow, the highest price to free cash flow was for Mindtree at 24.7 times, followed by L&T Technology at 23.1 times. Even Hexaware Technology was quoting at 21.9 times its free cash flow. So again, as I mentioned, we want this to be below 25 times. Next, let us compare the price with the book value of the company and price with the sales that the company has done. When we compare the price with the book value, what we are doing basically is comparing what the company considers its shares are worth against what the investors think the share should be worth. So either we can get at a premium to the book value, that is, the price will be quoting above its book value if the investors are bullish, or else we'll get it at a discount if investors are bearish. And book value is calculated by selling off all assets of the company, paying off all liabilities through that, and whatever balance remains goes to the shareholders and gets divided into number of shares outstanding. So we get the book value per share. L&T Infotech's book value is 5.3 times more, its market cap is 5.3 times more than its net worth or book value. L&T Technology's price is quoting 6.2 times higher than the share's actual value or net worth or actual worth. The lowest in terms of price to book value was seen for Mindtree, available at 3.4 times its actual share price, as per the company's records. Hexaware Technology was also quoting very high at 4.3 times. My benchmark for price to book value is below 2.5s. Or we can also, when all the peer group companies are quoting at a high book value, then we can take an average of these book values and consider that as a benchmark for that particular group of companies. There is a chance that certain group of companies would quote at a very high price to book value. In that case, we take the average and then use that as our benchmark. In terms of price to sales, both L&T Infotech and L&T Technologies are quoting at a high valuation compared to the sales, which means the total market cap of L&T Infotech is 2.7 times more than what the company earned through sales. Here, I want the price to sales to be as near to 1 as possible. If we are getting it below 1, it means the market cap is below the sales that the company has done, which then creates an opportunity for the investors. The highest price to sales multiple was for L&T Technology at 3.1 times. Mindtree was available at the lowest multiple of 1.6 times to its sales. Next, let us look at the growth in profit from 5 years and how the profit grew in the last 3 years. This is the compounded average growth rate in profit. Here we want the growth in profit to be at least 10% year on year or more than 10%. All of these companies have grown their profits at around 10% and more. The profit growth rate in L&T Technology was very high. So this needs to be investigated as to why the profit growth rate is so high in this particular company. Is it because the base year's profit value is low and the current year's profit value is high? When compared like this, then this will inflate to 157%. Generally, we don't get to see such a high growth in profits of any company until and unless the base year's profit value is very low. L&T Infotech's profit grew by 8.8% since 5 years. Mindtree has grown its profit at 11.3%, and Hexaware's profit has grown at 9%. When looking at the 3 years profit growth rate, all of these companies have done a double-digit growth rate. This looks more moderate for L&T Technology at 17% from 3 years back. So then this makes more sense that 17% is a reasonable growth rate. L&T Infotech in the recent 3 years has managed to grow its profit at a faster rate of 21% compared to its 5 years growth rate of 8.8. So whenever we see the 3 years growth rate being faster than 5 years, it shows that the company has done something correct because of which the profits are growing. Almost all of these companies have managed to grow their profits faster in the recent 3 years than how it was growing in the last 5 years. Next, we'll look at the price earnings growth rate ratio of the last 5 years and last 3 years. This ratio helps us understand the price earnings that we were paying for the company's earnings. Is that justified? Is that too high? Or is it reasonable? This is done or understood in PG. Basically, we are comparing the price earning ratio with the profit growth rate. Both of these ratios we have seen earlier in the previous graphs. We saw that the profit growth rate for L&T Infotech was 8.8% in the 5 years, and the price earning multiple that we paid was 17 times. So we are paying 17 times the earnings, and we are getting a growth rate of just 8.8%. Therefore, the PEG will be 2. So the way it is calculated is that we divide price earning by the profit growth rate, and we want this ratio of PEG to be below 1.5 times at least. L&T Technology's price PEG is 0.1, which is very good, which shows that the price earning that we paid, against that we are getting a very high growth rate in profit. Mindtree is available at the benchmark value of 1.5 times, so this is also reasonable. Hexaware's PEG of the last 5 years is 2 times, which suggests that the price earning that you have paid is high compared to the growth in profit. So when the PEG is below 1.5, it basically means that we will be able to recover or collect our initial capital that we paid to purchase the shares much faster. Let us look at the PEG of the 3 years. Here, the most reasonable was L&T Infotech at 0.8. So from the last 5 years, since in the current 3 years the profit was growing much faster, therefore the PEG also dropped to 0.8. So this is what we are looking at. From 3 years, it should have become better than the 5 years, which then suggests that the profit is growing faster and the price earning that investors are paying is justified for that particular script. All other 3 companies have also improved their PEGs from where they were in the last 5 years. Next, let us look at the sales growth over a period of 5 years and over a period of last 3 years. Sales is an integral part of any company's basic premise of operations. Without sales, the company we want the sales to be growing at least 10% and above year on year from last 5 years and even from last 3 years, which then would suggest efficiency of the management in increasing its sales, and it will also indicate that there is a demand for the company's product. L&T Infotech has grown its sales over the last 5 years at the rate of 13.9%, and in the last 3 years the sales has grown much faster at 17.3%. L&T Technology sales has grown at 106.3% over the 5 years, which also suggests why the profit has grown at such a high growth rate, which we saw earlier. Mindtree and Hexaware also have shown a high growth in their sales of 18 and 15% each. In last 3 years also, all of these companies have done very well to keep growing their sales. Next, we'll look at the return ratios of these companies. We'll begin with the return on equity of the 5 years on average and what was the RoE of the latest year. And then we'll compare the recent RoE with its 5 years average. And we would like to see an RoE of at least 15% and above, along with the latest RoE being above its 5 years average. which then shows bullishness in the return ratio. The green indicates the 5 years average and the orange indicates the recent ROE values. L&T Infotech return on equity over the last 5 years on average was 36%. Now we also have to understand what this return is. The return here in this case is profit, and equity is the money contributed by the shareholders. So basically what we are trying to understand is what is the profit that the company has generated on shareholders' money. Its latest ROE is 34%, which is slightly below its 5 years average. Here we want it to be at least 15% and above. All of these companies have managed above 15% return on equity, and the higher the better it is. L&T Technology has also had a very high ROE of above 30% over the 5 years as well as recent year. Mindtree and Hexaware had above 23% of ROE for the 5 years average as well as the recent ROE. Mindtree's recent ROE has gone above its 5 years average, which is a positive indication. Hexaware's recent ROE is very near to its 5 years average. So all of these companies have a very high return on equity. Next, let us look at the return on capital employed. In this case, the return in this particular ratio indicates the EBIT, earnings before interest and tax, and the capital employed indicates the fixed assets of the company, which also includes the depreciation plus the working capital. The return on capital employed should be at least 15% and above. Most of these companies have a high return on capital employed. L&T Infotech as well as Technology both have given a high return of more than 40% on the total capital employed. Whereas Mindtree and Hexaware have also given a high return of slightly above 30%. Here we want it to be as high as possible. Next, let us look at return on assets. This is the net profit divided by the total assets of the company, that is the balance sheet total, and we remove current liabilities from that and we divide it by net profit. So we get the return on assets. What is the profit that the company has generated on the total assets employed into the business, less the current liabilities. Here too, we want the ratio to be as high as possible. There is no fixed benchmark that we can refer to for finding an ROA, but we can look at the average of the peer group companies and consider that itself as the benchmark. Most of these companies have a very high return on assets. Highest return was generated by L&T Infotech at 35% of the total assets employed into the business. Next, let us look at the asset turnover, that is how many times over the company's assets were turned over into sales. This formula for this is annual sales of the company divided by the total annual assets of the company. Assets in this case is net worth plus borrowings. So as you would have observed, in different scenarios or different ratios, assets meaning changes. In return on assets, we are considering total assets less current liabilities, whereas in asset turnover, we are looking at only net worth plus borrowings and comparing it with the sales. For L&T Infotech, the sales were 1.9 times higher than the annual assets employed into the business. Here we want it to be as high as possible. That shows that whatever assets the company has employed, in this case net worth plus borrowings, whatever funds were deployed into the business, against that the company has done high sales or more sales than what the assets were. The highest multiple was Mindtree at 2.1 times its annual assets. Here we want it to be as high as possible, as I mentioned earlier. Next, this is an important graph to look at. This is the comparison of the earnings of the company of the last 5 years, comparing it with the cash coming in from operations, and also comparing it with the free cash flow that the company has over the last 5 years. First, we will understand what is the profit that the company has shown, against that how much cash has come in from operations, and out of that cash how much has been used up in buying of fixed assets and how much is left over as free cash flow. So this is the cumulative 5 years data that we are considering. Then after this we'll also look at the latest profit and cash comparison. L&T Infotech's 5 years profit was 5,100 CR. Against that the company received a cash of 4,900 CR. This was around 5% less than the profit that the company has earned. Against this cash, the company still has 4,280 CR as free cash. That is only very less amount of that, which is around 4% was used up. 12% of that was used up in buying of fixed assets. L&T Technology's 5 years profit was 2390 CR. Against that the company's cash coming into the business was 2290 CR, which is roughly 4% less than the profit. And out of this 2200 CR of cash earned through operations, 1954 is left out as free cash, and the balance amount of these two has been utilized in buying of fixed assets. So 14.7% of the cash coming in through operations was used up in buying of fixed assets, and the balance is left over as free cash. Mindtree's profit of last 5 years was 2,800 CR, against which the company received a cash of 2,868 CR. This is a very good way of looking at the profit and cash. We want the cash coming in through operations to be more than the profit that the company has earned. Out of that 2,800 CR of cash from operations, 2,100 is left over as free cash, which suggests that the company's cash coming in through the as earnings were more, the cash coming in through operations was more than 2% above the profits, and the investments in fixed assets was 23%. For Hexaware, out of 2,200 CR of profit, the company's cash coming in was 2,300 CR. Against that, 1,729 was used up in 1,729 was left over as free cash, and the balance was used up in buying of fixed assets. Let us look at percentage wise. For Hexaware, 4% cash came in more than the earnings, and 25% of that cash was used up in buying of fixed assets. So I already explained this chart. So let's move on to the next one. Let us look at how much profit the company showed in the latest year, that is 2019. Against that, how much was the cash from operations that the company showed in the cash flow statement. So out of 1,516 CR of profit, the company received a cash of 1,395, which is a shortfall of 8%. We want the cash coming in through operations to be more than profit after tax. For L&T Technology, the earnings or the profit was 700 CR, against which the company received a cash of 737 CR, which is around 5% more than the earnings. This is a good value. We want the cash to be as high as possible against the earnings of the company. Mindtree's profit was 754 CR and cash coming in was 631, which is a shortfall of 16%. Hexaware's latest profit was 584 and cash coming in was 549, which is a 6% shortfall. So only L&T Technology has managed to gain or earn more cash than what it showed as profit. Here we want a positive value and as high as possible of cash earnings against the profits shown by the company. Next, let us look at the average profit of the last 5 years and the latest 12 months profit after tax value. And then what we'll do is we'll compare the latest profit against its average and understand whether the company's latest profit is above or below its average of 5 years. L&T Infotech's current year's profit or 5 years average profit was 1038 CR, against which the latest year's profit was 1510, which is a increase over its average. L&T Technology's 5 years average was 478 and the current year's profit is 754, which is again above the average. In fact, most of these companies, all of these companies have managed the latest profit above its 5 years average. Let us look in percentage terms about this regarding the same thing. The profit after tax latest year compared with the 5 years profit, average profit figure. L&T Infotech's latest profit was 45% above its 5 years average. L&T Technology's profit was above its 5 years average by 58%. So this is a very good value. So it shows a strength in earning above the average. Mindtree and Hexaware also showed a above average profit in the current 12 trailing months against the 5 years average. Next, let us look at what was the growth rate in profit from 2018 to 2019 for the first 3 companies and from 2017 to 2018 for Hexaware Technologies. All of these companies have shown a sequential year-on-year profit growth rate of more than 30% for L&T Infotech, L&T Technology as well as Mindtree. Hexaware's profit growth rate from the previous year, that is from December 17 to December 18, was 17%. All of these growth rates are very good. Even the 5 years, the latest profit against compared it with the latest 5 years average profit is also very good. In terms of quarterly YOY sales and profit growth rate, L&T Infotech has grown its sales at 15% and the profit had a fall of 2%. Here we want to see a growth year on year, that is from March quarter to March quarter. In this case, it is the latest quarter's data that is available. So we would want to see not only the sales growing year on year, but also the profit should be growing, like in L&T Technology, where the sales was growing as well as the profit was also growing at 37%. Mindtree saw a growth in sales of 12% but a fall in its profit of 41%. Hexaware's sales had grown by 21%, but the profit grew at only 2%. So the higher the sales and higher the profit, the better it is. Next, let us look at the sequential quarter on quarter sales and profit growth rates. L&T Infotech sales were at the same level as it was in the previous quarter, and the profit dropped by 6%. L&T Technology's sales grew by 1% and profit had grown by 7%, which is a good sign. Hexaware's profit and sales also had seen a growth of 1% and 12%. But Mindtree's sales didn't increase, but the profit dropped by 53% over its previous quarter. So there's definitely something wrong here, where sequentially as well as quarter on quarter, both year on year as well as quarter on quarter, the profit has seen a fall. Next, let us look at the net worth against the contingent liability. Net worth is the actual worth of the company against the market cap which investors look at. Here we are trying to understand what is the company's actual value, which is calculated by clearing all liabilities and by selling all assets. Whatever balance remains between the difference of assets and liabilities is the actual net worth of the company. And in terms of contingent liability, we want to understand how much the company's contingent liability is and how that compares with the net worth. Here I don't want the contingent liability to exceed 20% of the net worth. Contingent liability are those liabilities which may or may not arise in the future, and also it is not shown in the balance sheet, so we have to be a little careful. The highest net worth company of the four is L&T Infotech at 4,800 CR. Mindtree is quoting at 3,353 CR of net worth, and other two companies, L&T and Hexaware, are very nearby to each other. So all of these companies are mid-cap companies, and none of these companies have a very high contingent liability. In fact, Hexaware and L&T don't have any contingent liability. Mindtree has a 7% contingent liability, which works out to 229 CR. So we want the contingent liability to be as low as possible. Next, we'll look at the debt to equity ratio, debt to profit ratio, and interest coverage. For most of these companies, as we can see, all these three companies, or in fact all the four companies, have very less debt, or in fact no debt at all. Therefore, their debt to equity and debt to profit is 0 times, meaning they have no borrowings, and therefore they would have a very high interest coverage. That is, their EBIT is, for example, L&T Infotech's earnings before interest and tax is 76 times higher than what it paid as interest cost. Hexaware's earnings before interest and tax was 145 times higher than its finance cost or interest cost. So the higher the number, the better. The debt to equity ratio should be less than 1, and debt to profit should be as near to 1 as possible, which suggests that the profit that the company has earned can pay off the debt within 1 year. Since none of these companies have any borrowings, we'll move on to the next chart. Promoter holding and pledged share. Promoter holding should be more than 50% or as high as possible, which indicates that the promoters have a high stake in the company and would try to run the company in the best possible manner and grow the sales as well as profits, which would ultimately benefit them and the shareholders. And the pledged shares is the part of the promoter's holding which has been pledged with banks to raise money either for their own use or to deploy it into the business. In this case, none of the promoters' shareholding has been pledged, and also L&T and L&T Infotech as well as Technology have a high promoter holding of 75% each. Hexaware's promoters are holding 63%. Mindtree's promoters are only 13%. And none of these companies have pledged their shares. Next, we'll look at the debtors to sales, which would indicate to us what is the total accounts receivable to be collected against the latest year's sales, that is 2019 sales, and within how many days is the company collecting money from these debtors or from these accounts receivables, and 3 years back how well or how fast was it collecting payment from the customers. L&T Infotech's debtors were 18.7% of this year's sales, which generally indicates that if the company had done a total sales of 100, then 18.7 or 18 CR of that 100 would be the debtors standing. So here we want the debtors to not exceed 30% of the sales. In terms of collection days, most of these companies are collecting slightly above 60 days, which is still good because my benchmark is less than 90 days. That is, the company has to collect payment from its customers within 90 days or 3 months. L&T Technology's debtors as well as Hexaware's debtors were slightly above 20%, whereas Mindtree and L&T's were below 20%. And all of these companies were collecting payment at a decent pace of less than 90 days. L&T Technology's 3 years back collection days was almost 90, and now they're collecting it at a much faster rate at 79 days. Next, let us look at the inventory turnover. In fact, there is no inventory in these companies, so we'll skip this particular part. Next, we'll look at the average OPM of the last 5 years and also look at the latest net profit margin of 2019 and the net profit margin of 2018. So this would help us understand the profitability or the margin that these companies are commanding in the market. All of these companies' OPM were above 15%. L&T's OPM was 18.6, Technologies was 17.6, Mindtree's was 15.6, and Hexaware's was 16.6. So I want the OPM to be at least above 15%, which is what all of these companies are generating. The net profit has to be more than 10%. L&T Infotech's NPM was 16.1% in 2019, whereas in 2018 it was 15.2%, which means the company's margin has increased over 2018. Same is the case for L&T Technology, where 2018 NPM was 14% and 2019 NPM was 14.9%. So there was an increase in the margin as well. In fact, most of these companies, as we see, have managed to grow their margins over the previous years. Next, we'll look at the current ratio and quick ratio. These are the liquidity ratios and help us understand whether the company's assets are enough or current assets are enough to pay off the current liabilities. As we can see, most of these companies' current assets to current liabilities ratio is more than 1 times. So all of these companies are doing very well. Their assets are enough to pay off the current liabilities. Finally, let us look at the gross block, that is the assets at the acquisition cost. How much of that, how much was the accumulated depreciation? Out of that, after removing accumulated depreciation, what was the net assets or net block of the company? And on that net block, what was the depreciation rate charged? L&T Infotech's total assets were 1,831 CR at its acquisition cost. Mindtree's assets were 2,051 CR. Both of these companies had high assets at their acquisition cost. Out of that, we are trying to understand how much was the accumulated depreciation. So out of 1,830 CR, 900 CR was already depreciated. So this expense of depreciation is already deducted from the P&L. After removing the accumulated depreciation is the net block of the company, that is the net assets, that is 930 CR, and it is being depreciated at the rate of 147 CR. And this expense of 147 goes into the P&L and reduces the profit. So what we are trying to understand here is that the accumulated depreciation has to be as high as possible, which then indicates that already most of the assets have been depreciated, and the new assets or the asset it still holds, that is being depreciated, and what is the rate at which the depreciation is being charged to the P&L account. L&T Technologies gross block or total assets at acquisition cost was 809. Out of the 243 CR has already been depreciated. 565 CR is left over, and it is being depreciated at the rate of 73 CR. Same is the case for other two companies. Mindtree's total assets were 2051. Out of that, almost half of it has already been depreciated, and 1558 CR, meaning more assets have been added in this year along with the previous assets, and on that 164 CR is being depreciated this year. Let's look at percentage wise how these companies have done, meaning we want the depreciation to be as high as possible, as I mentioned earlier. This basically concludes my analysis of these companies, and let us rank them now and understand which of these companies have done the best in which of these ratios. I have ranked all of these companies and color coded them according to the markings. The ones in the red represents the lowest score for that particular ratio, and the one in the green represents highest score or the best score. After giving all these markings, this is a very simple marking where I rank them from 1 to 4, and the better the score, the better the ranking. So it's a very simple score to understand out of all these ratios which company has got the highest. L&T Infotech has got the highest score of 149 points. L&T Technology has got 131 points. Even Hexaware Technology has got 131 points. And Mindtree has got the lowest at 111 points. So then we can decide which ones are, which of these companies have received the best score, and accordingly decide if you want to invest in that particular company. Face value was best for Mindtree at 10 times, or 10 was the face value, and Hexaware's face value was 2. Even L&T Technology's face value was 2, and the highest split was seen in L&T Infotech at 1 rupee. The highest fall was seen in Mindtree at 41% and Hexaware at 28%. The lowest fall was seen in L&T Infotech and L&T Technology, both at 24% and 21% from their respective 52 weeks high. In terms of earnings yield, the highest yield was seen in L&T Infotech and Mindtree at 5.8% and 6.1%. And the lowest yield was for L&T Technology and Hexaware at 5 and 5.5%. In terms of price earnings multiple, the best score was L&T Infotech and Mindtree at 16.5 times and L&T Infotech at 17.2 times. L&T Technology was the most expensive in terms of earnings at 20 times, and Hexaware's price was quoting 18.5 times. When compared to the historical price earning of 5 and 3 years, L&T Infotech was available at the cheapest valuations, and Hexaware was available at 18.1 and 18.6%, or 18.1 and 18.6 times its earnings. L&T Technology was most expensive in this 5 and 3 years, quoting at 23 times its price. In terms of price to OCF, the best valuations was available for L&T Infotech and Mindtree. Both were available at somewhere around 18 times. Here too again L&T Technology was expensive at 20 times. In terms of free cash flow, L&T Infotech was available at 20 times its free cash flow and Hexaware at 21 times. The other two companies, L&T Technology and Mindtree, were available at 23 and 24 times its free cash flow. In terms of book value, highest book price to book value was seen for L&T Infotech and L&T Technology, both quoting at a high valuation to its book value, and Mindtree and Hexaware were available at 3.4 and 4.3 times its book value. Although these two are also very high, as my benchmark is 2.5 or less than 2.5. Next, price to sales. Again, L&T's, both the company of L&T were very expensive compared to the sales. They were available at 2.7 times of sales and 3.1 times of the latest year's sales. Whereas Mindtree was available at just 1.6 times of sales. That is, price for each share was quoting at 1.6 times more than the sales per share. Even Hexaware was available at 2.2 times. The profit growth highest in last 5 years was seen for L&T Technology at 157% and Mindtree at 11%. Whereas L&T Infotech and Hexaware saw the lowest profit growth of 8% and 9%. My benchmark is 10% and higher. In terms of profit growth in last 3 years, L&T Infotech has done very well, as well as L&T Technology. Both have grown their profits at above more than 17%. Mindtree and Hexaware saw a lower profit growth rate compared to its peers of 11% and 14%, which is again good, but compared to the peer, it is low. In terms of price earnings to profit growth rate, L&T Infotech and Hexaware both have got a PEG of 2, which is expensive compared to L&T Technology and Mindtree, available at around 1.5 and less than that. The best PEG was for L&T Technology, meaning the price earning multiple that we paid for L&T Technology. Against that, we are also getting a very high growth rate in profits. For PEG of 3 years, L&T Infotech and Technology both have got the highest score, because their PEG is 0.8 and 1.2. Even Mindtree and Hexaware's PEG has improved, and it is 1.5 and 1.3. So all of these numbers are good for their latest 3 years price earnings to profit growth rate comparison. In terms of growing sales over the period of 5 and 3 years, L&T's sales has grown at a phenomenal rate of 106% from 5 years back and 17% from 3 years back. Even L&T Infotech has done well at 13.9 and 17.3% of growth rate for both 5 and 3 years. In fact, all of these companies have grown their sales at a good above 10%. In terms of return on equity, that is return on shareholders' money, all of these companies have done very well at earning more than 20%. Although L&T, both companies of L&T have done well of above 30% of growth rate for both 5 years average as well as the latest return on equity of 2019. Although L&T Infotech saw a fall in its return on equity from 5 years back of 12%, and L&T Technology saw a growth of 65% from where it was 5 years back. So it has been growing its equity from 5 years on average. Mindtree and Hexaware saw a fall of 3.4 and 3.5 and 3.4% each in return on equity. In terms of capital employed and profit generated on it, both L&T companies have done the best. Although Mindtree and Hexaware also have done very well, generating a return on capital employed of more than 25%. So all of these companies are good, but certain ratios are low in peer group comparison. In terms of return on assets also, we see most of these companies have done very well of generating high return on total assets employed. Asset turnover was again good for all of these companies. In fact, asset turnover was 1.9 times for most of these companies, and Mindtree's assets converted to sales was 2.1 times. In terms of invested capital and profit generated on it, both L&T companies have done well of generating a high above 50% of returns on the invested capital. Invested capital, as I explained earlier, involves the net assets of the company and adding working capital to that. Mindtree and Hexaware also had a good high double digit above 35% of return on invested capital. In terms of cash conversion of profit over the 5 years, Mindtree and Hexaware have earned more cash than what it showed as profit over the last 5 years, and L&T and Infotech, both the L&T companies, cash coming in through operations was less than what it showed as profit after tax. Although it was a minor shortfall of minus 5.4% and minus 4.2% each. In terms of free cash flow, the least utilized in buying of fixed assets was by L&T Infotech and L&T Technology. They utilized only 12 and 14% of whatever cash they earned through operations into buying of fixed assets, whereas Mindtree and Hexaware has deployed above 23% in buying of fixed assets. Although these numbers are very low, my benchmark is that not more than 50% should be utilized in buying of fixed assets from whatever cash the company is earning. This is just my benchmark. If you can increase it to 60%, 70%, that is according to the comfort level of the investor. Next, let us look at how the profit has grown above the 5 years average profit. Both L&T companies have grown their profits at a very high rate. L&T Infotech's profit of the latest year has grown 45% above its 5 years average, and Technology managed to grow its profit at 57% above its 5 years average. Even Mindtree and Hexaware have done well by growing the profits of 22% and 30% above the 5 years average. In terms of growth over its previous year, all of these companies have seen a growth YOY, that is from 2018 to 2019, of more than 30%, except Hexaware Technology, whose profit growth was 16.9% year on year from December 17 to December 18. In terms of converting profits into cash annually, that is of the latest year, L&T Infotech, Mindtree and Hexaware, all three had a shortfall in their cash conversion. Only L&T Technology saw a higher cash earnings against the profit by 5.2%. In terms of growth in sales over previous quarter as well as sequentially, and growth in profit over its previous quarter as well as sequentially, L&T Technology seems to have done the best in growing over the quarter on quarter period, along with Hexaware, where its profits and sale both had a growth of positive values. Mindtree saw a sales growth of 11% but a fall of 41% YOY, that is quarter on quarter. Whereas also even L&T Infotech even though it saw a sales growth of 15%, it saw a fall in profit of 1.5%. The highest net worth companies, the largest in size, were L&T Infotech and Mindtree at 4,800 CR as well as 3,300 CR. The other two are around 2,400 CR companies. In terms of contingent liability against the net worth, all of these companies had a very low contingent liability. Highest was seen for Mindtree at 6.8%, but this also is very low. All of these companies are debt-free companies, therefore the interest coverage is very high. Even debt to profit would be zero because there's no debt or there's no borrowings. Promoter holding is high for all of these companies except Mindtree, where promoter holding was just 13.3%. None of these companies have pledged any of their shares. All of these companies, debtors or collection from customers is less than around 20% or somewhere around 20%, so which is again good. The benchmark is that the debtors should not be more than 30% of the sales of the latest year. So in that sense, all of these companies have done well. In terms of collecting payment from customers, all of these companies are somewhere nearby to each other. The 5 years OPM or operating profit margin was seen highest for both L&T companies. Even Mindtree and Hexaware have done well, of above 15% of operating profit margin over a period of 5 years. In terms of net profit margin of the latest year and net profit margin of the previous year, that is 2019 and 2018, all of these companies have seen above 10% of net profit margin, which is my benchmark. In terms of current ratio and quick ratio, also all of these companies have done well, of above two times current assets to current liability ratio. In terms of accumulated depreciation to the gross block percentage, that is how much of the gross block, that is assets at the acquisition cost, was already depreciated, the highest depreciation was accounted by L&T Infotech and Mindtree, which means that only for example for Mindtree only balance 50% or 48% of its assets are left over for depreciation, which would then go to P&L account as expense and reduce the profit. So we want that if the companies have assets, their accumulated depreciation should be as high as possible, so that most of those expenses have already been accounted for. In fact, most of these companies have a very good accumulated depreciation percentage. In terms of how the net assets are being charged or depreciated over the period of future years, all of these companies' depreciation rates are very nearby to each other. But the fastest depreciation of assets is by L&T Infotech. They are depreciating the net block at the rate of 15.8%. The highest dividend yield was seen for Mindtree and Hexaware at current market price of 4.8% and 2.4% each. Next, let us finalize in terms of different metrics how these companies are or they stack up against each other. Let us look at the efficiency metric first. I have included the asset turnover, contingent liability to net worth, debt to equity, interest coverage, debt to profit, debtors to sales, debtor days, inventory turnover, accumulated depreciation to gross block, and depreciation on net block. These ratios, I have combined them into efficiency metric, which I give it the highest importance. This shows how well the company is managing its business, or how well the managers of the business are conducting the business in the most efficient manner. And using these ratios, we can understand what is the debt the company has picked up against the sales. What are the debtors against the sales? How many days it is collecting to collect payment from its customers? What is the interest coverage? Are they in a comfortable position to pay off their interest liabilities? What is the debt against the equity, and so on? So for me, efficiency metric comes first. Then is the solvency metric, in which we look at what is the promoter's shareholding, how much they have pledged, what is the current and quick ratio. Then the third in line is cash flow metrics, which is again very important, because here we have to understand how much of the profit has the company converted into cash, or how much cash the company has actually received against what it has shown as profit in the last 5 years. How much of the cash that they earned is still remaining with them as free cash flow. And then also the latest profit to cash conversion. Next, I'll look at the growth ratio. This shows how is the company growing its sales over a period of both 5 and 3 years. How are profits growing? How is the growth rate in return on equity from 5 years? How is the profit growing above its 5 years average? What is the growth rate in profit year on year? Then we'll also look at quarter on quarter growth rate in sales, YOY as well, and profit. And then finally, we'll also look at the net worth. In terms of written metrics, this is the earnings yield that the company has earned on its price, the profit that it has earned on its price, return on equity of the last 5 years on average, then latest year's ROE, RoCE of the last 5 years on average, the latest RoCE again, and a return on assets of the last 5 years, return on invested capital of the latest year, OPM of the last 5 years on average, NPM of both the latest year as well as its year prior to that, and dividend yield. And finally, after we analyze all of these, we have to understand where the price is in terms of valuation. Is it good enough to be picked up? So I have included price earning of the latest 12 trailing months, price earnings of both historical 5 and 3 years average, where the price is compared to operating cash flow, free cash flow, book value, sales, and then price earnings growth rate that we are paying against the 5 and 3 years average growth in profits. So as for me, these are the order in which I look at for the companies that I'm interested in investing. Hexaware's efficiency metric is the highest, along with L&T Infotech at 29 and 28 points. L&T Technology's efficiency is low at 20 and 19 points for Mindtree. In terms of solvency, Mindtree and Hexaware are the most solvent of the companies, and they are not, even L&T group companies is not very far behind both of these companies. Just a matter of 1 point difference between each of them. In terms of cash flow metrics, or how efficiently profits have got converted into cash, L&T Technologies has shown the highest conversion of cash into profit at 9 points, followed by Hexaware at 8 points, and even all of these companies are again nearby to each other. The lowest cash conversion was seen by Mindtree, which got just 6 points. In terms of growth metrics, how the sales and profits were growing, L&T seems to have been growing its sales at the highest pace. It has got 41 points, way ahead of all of the other companies. Hexaware has scored near to L&T Infotech. They are nearby each other at 30 and 28 points. The lowest profit and sales growth was seen for Mindtree at 21 points. In terms of written metric, that is the profits generated on different variables, L&T Infotech has generated highest returns on different, when we compare the profit with different variables from the balance sheet. And L&T Technology also, both of these L&T companies have generated high returns on different variables. And L&T Infotech is way ahead at 41 points compared to L&T Technology at 29 points. The other two group companies have scored low on written metrics. In terms of valuation metrics, that is the price, earning and so on, L&T Infotech has scored the highest at 30 points, followed by Mindtree at 26 points. So these two companies are very reasonably valued and can be bought into. At 26 points for Mindtree, and L&T Technology seems to be most expensive in terms of valuation at just 19 points. After we conclude this grouping of different ratios into metrics and giving it a score between 1 and 4, both Hexaware Technology and L&T have got equal score of 17 points, although by individual ratios they had got different points of 149 and 131. But when we group them together, both of these companies have done exceedingly well of scoring 17 points. L&T Technology comes third at 15 points, followed by Mindtree at 11. So this concludes my analysis of this particular companies. Thank you for watching this video.